Welcome to 5 Barrel Factors, the channel where we break down the 5 key forces shaping global crude oil prices. During week 41 of 2025, the benchmark Brent crude slipped 0.5% week over week, falling from $67.3 to $67.0 per barrel. Here are 5 key factors that influenced oil prices over the past week. First, Israel-Hamas peace pact pressures prices. Crude futures settled lower after the White House announced Israel and Hamas had agreed to phase 1 of a peace plan. The deal includes partial Israeli troop withdrawals from Gaza and a prisoner exchange, signaling a fragile but notable de-escalation. Analysts at Rystad Energy said the agreement could pave the way for fewer Houthi attacks in the Red Sea and even reopen channels for Iranian oil exports. Since the war began in 2023, over 130 merchant vessels were attacked in the region. A shift toward stability has trimmed geopolitical premiums that previously added several dollars per barrel to Brent. Easing tensions reduce risk premiums, pushing prices lower. Second, U.S. sanctions hit China's Rizhao crude hub. The U.S. Treasury sanctioned China's Rizhao Shahua terminal on October 10 for importing Iranian crude oil, marking one of the most significant disruptions to Sinopec's logistics chain. The hub, handling 55.88 million metric tons in 2024, around 804,000 barrels per day for Sinopec refineries, now faces uncertain operations. Rizhao processes about 11.8% of China's total October crude inflows, or 1.33 million barrels per day. Iranian arrivals dropped to 100,000 barrels per day from 493,000 barrels per day a year earlier. Previous sanctions forced 5 out of 6 similar terminals to suspend operations. The move may squeeze near-term Chinese refinery supplies and redirect cargoes. Supply disruption risk supports prices. Third, port fee crossfire escalate trade tensions. Starting October 14, China will impose new port fees on US-owned, US-operated, or US-built ships, 400 yuan, around $56 per net ton, rising to 1,120 yuan by 2028. The policy follows US tariffs of $18.50 per ton on Chinese ships. The tit-for-tat escalation targets vessels 25% or more US-owned, potentially affecting container, bulk, and LPG carriers trading with China. Shipping analysts warn of increased costs on trans-Pacific routes and disruptions in energy transport. With roughly 100 US-flagged ships trading internationally, even small bottlenecks can tighten short-term logistics. Higher freight and transport costs lend mild upward pressure to oil prices. Fourth, global oversupply expands through 2026. According to the US EIA's October short-term energy outlook, global oil stocks are set to build by 2.6 million barrels per day in Q for 2025 and remain elevated through 2026. Brent prices are expected to average $69 per barrel this year before sliding to $52 in 2026 as supply growth outpaces consumption. Non-OECD Asia drives most of the 1.1 million barrels per day demand.